Welcome back to this week's market drama. This past week did not disappoint. The S&P 500 fell 2%. That puts it down 17.8% for the year. Treasury yields fell, which means treasury bonds prices went up. Specifically, the 10-year treasury yield fell 17 basis points. This came back in for a number of the reasons, when it came to yields as well as when it came to the markets. So first, I'll start with CPI. We had November CPI numbers out. They were better than expected. So for instance, core CPI was up year over year, 6%. It was expected to be up 6.1%. So a little bit cooler than expected. The market rallied, the stocks rallied in the back of this on Tuesday. And on Wednesday, the Fed announced that they're hiking the 50 basis points to 4.5% for Fed funds rates. That's as expected, but the commentary by the chairman is really what drove the sell-off in the second half of the week. So this is a quote here. Inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. That's great. That's what market wants to hear. But it will take substantially more evidence to have confidence that inflation is on a sustained downward path. Boom, market sells off. We do not want to hear that, right? Stock market participants do not want to hear that. So this goes back to what I've been saying the last couple of weeks. The market is kind of fixated on reading the signs as if the Fed is kind of winking at them and saying, hey, don't worry, we're going to pivot soon and stocks will go up. That is not what the Fed is fixated on right now. They're trying to bring down inflation. In fact, when the stock market rallies, it's inflationary. It eases financial conditions. And that is not what they're looking for. I'm going to go a little bit off script of what we usually do here. I want to share a chart that I think is really telling of this idea of like the market is just misreading what the Fed is saying or is not believing what the Fed is saying. This chart is comes from Bianco Research. The blue line is what Chairman Powell has been insisting is the discount rate for the market, right? That's the Fed funds rate. Is saying that next year is going to stay at 5.125. Those other lines is what the market is looking at when it comes to the discount rate, right? So if you could see the huge gap, especially when you look at the 12/16/2022, which is the green line, the market's expecting a discount rate by the end of next year of 4.4. The Fed is telling us it's 5.125, right? So huge disconnect, and the market just keeps kind of buying this idea that the Fed will pivot next year. We'll see who wins this out. I'm more in the camp that the Fed needs to keep interest rates high enough to really bring down inflation, even if we actually see a recession next year. But so far, the market seems to be saying, I don't buy it. I think the Fed will actually lower interest rates if we do face a recession. Yes, inflation is coming down, but they're going to care more about the recession. So we'll see what happens there. The other thing worth noting from last week is retail sales declined 0.6% for November, month over month. Why is this important? Well, consumption is 68% of GDP here in this country, right? If you look in my garage, you know why. We love to buy stuff. So when retail sales is down, that's an indication that the most important driver of growth is not looking so hot going into next year. We also had manufacturing PMI decline to 46.2 from 47.7 in November. Below 50, it means contraction. So 46.2 shows manufacturing slowing down here in the United States. What to look for next week? Or I should say, well, I'm filming this on Monday, so this week. Tomorrow, Tuesday, we have November housing starts and new and existing home sales out. As you know, real estate and housing is really important indicator for the overall economy. So we'll see how November panned out, especially when interest rates continue to stay at elevated levels for mortgages. And then we also have on Friday the PCE index for November. This is the Personal Consumption Expenditure Index. It's kind of like the cousin of CPI, measure for inflation. The reason this is one so important is that the Federal Reserve likes PCI more than CPI. The way they create this index, it does include certain items that are out of the scope of CPI, So this is the one that the Fed kind of points to. They are very academic, the Federal Reserve. So they also like to use kind of like well, we look at a different index, right? Our index is cooler and yours is a little more wonky. So that's really, that's just for me to share with you guys, but that's really the reason they like to look at it. They don't like to, they kind of put their nose up a little bit at the CPI, but nonetheless important because they're looking at it. And if they're looking at it, they're going to use that as a measuring stick for inflation. Let's keep an eye on that one on Friday. That's it for this week. Happy holidays and stay tuned for next week.